so that you can do your taxes. Just to think about so that you can do your taxes well if you do them on your own or you just want some wisdom on it. So we do have a person that if you have questions during the show, please just put them in the chat. Vanessa will write them down and hand them to me, and we'll try to answer those as best as we can. And as always, this is recorded. You can go to our YouTube channel at ProVisor and see all our past Ask ProVisors. We had a lot of different topics: underwriters, appraisers, home insurance people, legal attorney from the WRA. So with that, let's get started. So thank you, Cori, for joining.
Sure, you're welcome.
And let's just jump into tax implications for buyers. So when I help a lot of my customers, they need a gift. Like they just don't have the money for a down payment. So what if a parent or a friend is giving a gift of real money to help buy a house? Is there a tax implication for either party, the one giving it or the one receiving it?
So the way to talk about gifting is, and this is the question that I get often, is that I want to give money, or in the case of I want a gift of equity.
Sure.
What we need to talk about is gift tax. And so gift tax is basically you are able to gift to someone $18,000 a year, and it's indexed every year up.
Okay.
And it's tax free. And I would actually say it's not recordable. So it's not that it's tax free necessarily, is that you don't even have to record it. It's not a taxable event.
Okay.
For you to gift someone money, $18,000.
Okay.
And the reason I say it that way is it's easier to understand what does happen to it.
Okay.
So gift tax and gifts of money are tied to your estate. So you can actually die in this country with an estate that's, if you have an estate that's under 13 some million. And
you just gave it like little over 13 million.
High, right? Something we don't see that much here. But so estate tax is what you want to be thinking about. And so gift tax is basically saying you can pass without having to pay estate tax on your estate as long as it's under 13.8.
Okay.
So as you give away money, they want to make that 13.8 smaller by all the times that you gave more than 18,000 a year.
Gotcha.
So what I'm saying is it's record everything over every time you give over 18,000 to one person. It only dings your ability to die with 13 million tax free.
Got it.
For most people, it's not a tax. It's, do I have to record it?
Okay.
And then it's related to estate tax. So again, if you give, and if you do give more than 18,000, you have to file a Form 709, and that is a filing or recording only. There's no gift tax tied to it.
Okay.
Unless you are over the 13.8, unless your state is
down.
So, so really it's just a recording. And I get that question a lot though. Yeah. Because people think, well, of course the IRS is going to be involved in this transaction.
Right.
But it is not, because it's cash. It's you can give it to whoever you want.
As you know, as a non-tax person, when I run to my customers and I think myself, I'm like, oh, if I'm going to give somebody money, I'm going to have to pay taxes. That's where our knowledge stops, right? Right. And that's why we got that question for someone is giving that gift. So does it? We do some loans too that it's not real money. It's a gift of the equity in the house. So if a family member sells to another family member and they want to bless that family member, they can give the equity. Is it different because it's equity and not real money?
No, it would be something you'd want to check. Give us a call so we can walk through, because then you change the basis in the house for when you sell it in the future.
Okay.
I would stick with give us a call on something like that, because we want to use the individual. We want to answer that individually, because what was the house used for? Was it ever used as a rental property? It gets a little hairier other than that, but generally, no, you're really only talking about recording that equity if you're talking about recording it at all.
Okay. So for the real estate agents out there, when they're dealing with people selling a house and buying a house, this is what I heard. So I'm going to ask it for you all. What they should be telling their customers, like, hey, you call a tax person, get the professional answer. I think you have a concern that maybe is not a concern, but we want you to get the expert advice as a real estate agent. Please call your tax person so you know in this transaction.
That's exactly how I would say it, because what we don't want you to do, and of course we don't want to either, is to weigh in on something that goes beyond what we're really knowledgeable about. And we want to partner with real estate agents. So it's sort of, we don't want to say, hey, you can't have any advice. Like when you take on a new workout plan, talk to your doctor.
Talk to your doctor.
Like, it's not really a disclaimer. It's really, let's work together to make sure that you get the information.
And we may have that surprise person who they're selling a $250,000 house, and all you were as an agent, you're concerned about that transaction. You have no idea they have this $20 million sitting someplace.
Right.
Because why would you ask that question if you're helping them sell a house, right?
Yeah, we would be happy to weigh in on that question for them.
So now they're selling the house and there's fees. And I just want to run through a couple that you can, so that they're aware of. Is there reasons this person should care about their taxes with the topic? So for instance, discount points. If somebody pays money to get an interest rate down as a buyer, is that a tax credit or deduction at some point?
Yes, I mean, discount points are prepaid interest.
Okay.
So they function on the tax return exactly like any mortgage interest would be.
Okay.
And it's written right on your mortgage, your 1098.
Okay.
So the points are, again, on a home origination loan, which is when you first buy it. Those, if you pay points, it's directly deductible like mortgage interest.
Okay.
If you refinance, where you also could have loan origination points or fees, those actually have to be amortized over the life of that loan, 15, 20, 30.
Okay.
So a refi can sometimes be less of a credit because even if you pay it up front, which is what it is, you have to take it and amortize it. So you have to keep track of it.
Are there any other fees at the time someone's buying a house that could help them or hurt them with taxes, like title company fees, government recording charge, appraisal? None of that?
No, because it's a personal home.
Okay.
Those all come into play if they're buying an investment property.
Okay.
So if ever you are buying an investment property, one of the things that most of my clients forget to bring in is the closing papers.
Okay.
So we need to look at all of those fees because they add to the basis of the house.
Got it. Okay. And we're going to talk more of the sellers in a minute. Okay. So this is not on our list, but what I kind of remember as we were talking before we came on camera, there's all these old rules that people don't know the change. So here's an old rule. I don't know if it still exists. If a seller is moving, is their moving expenses deductible?
Unfortunately, they are not.
They're not.
No longer, right?
Okay.
They're no longer.
That went away.
Yeah.
Okay.
I mean, there may be some expenses if it's for military, for very, very specific occupations, but in general, no.
And for a buyer, I know I just said seller, buyer, same
Either
thing.
one.
Okay.
Yeah. When they simplified the tax law in 2018, those types of things went away. Other things that went away were, let's say, being able to take your cell phone or union dues or tax fees.
I remember that.
But they did double the standard deduction, which is a benefit. So we can talk about that as well. But moving fees, moving costs.
I offered on my first time home buyers a thing called a mortgage credit certificate from the IRS. And it is very helpful to them. It helps. I can use it as income to buy a house. And it also is, I tell customers, it's a credit on your taxes. Right. So can you just I know real estate agents here, this is maybe getting a little geeky, but I want you to understand it because this is a huge benefit. And if you're working with anybody that's a first-time home buyer and they're asking about down payment assistance and help with closing cost stuff, this is another topic that really helps them with potentially a lot of money because it's worth up to $2,000 every year. So it's a credit, not a deduction on your taxes. So what I asked Cori to kind of talk about is in like 30 seconds or so, kind of explain how does it fit into a tax return when they get it?
Right. Well, quite simply, once you've determined what your taxes are, what you have to pay in tax, as long as you have tax there, as long as you have some tax more than 2,000, you take that and you subtract the amount of the mortgage credit up to 3,000 off of your taxes. So you could think of it as I'm reducing my taxes, or you could think of it as I'm increasing my refund, right? So if you have a refund, the
refund gets bigger.
If you have tax.
Awesome.
So it's a great program. And I don't see it very often. And I am curious to ask you why that is. It's meant for people of more modest means to be able to afford or to buy up, right? Yeah. I just am curious why I don't see more of it, because all you have to do is every year supply that mortgage certificate showing that you qualify. And it just seems so helpful.
I wish I could give you the real reasons why I would know someone else doesn't do that. I'm shocked too. I talk to real estate agents. When I talk to you all, I tell you about it so you're aware of it. I think it should be offered to every first-time home buyer that fits the criteria, which has an income limit. And it's also not just for first-time home buyers. It's also for disabled veterans. I mean, not might be just veterans in general, and if they're buying a house in a certain HUD designated area.
Mhm.
So on the other two cases, you can be a repeat buyer to do that.
Mhm.
I don't know.
Well,
I think about it every
yeah.
time I do a loan
Yeah.
because my role is to give them all the information, just like you would as a tax person,
Mhm.
and so they can understand their situation. Because think about it, if it's worth $2,000 every year,
Yeah.
they can get it every year. They own a home and have a debt. Well, in the first 10 years, this thing could be worth 20 grand in their pocket.
Right.
you
Yeah.
know?
Well, and it's good that you're talking about it because again, we need to find vendors that are going to go that extra mile.
Yeah.
for
Yeah.
people.
All right. When you see a piece of paper being handed, it means we've got a live questions from the audience. So I'm going to do one of our prepared one, and I'll come back to this one. We talked about disabled. We just talked about veterans.
Yes.
Disabled veterans.
Mhm.
And I don't know if it's all 50 states, but I know it's a lot of states that each state has their own program to help disabled veterans with property taxes.
Yes.
And in the state of Wisconsin, which is most of our audience here, it is a refundable thing after it's paid, right?
Yes. Mhm.
And then it flows through their tax returns to actually get the money. Am I correct so far?
Yes, what it is if you're 100% disabled. So
Mhm.
the credential part, I don't get involved in as much, but I believe you have to have a certain level of
Yes.
disability, right?
Mhm.
You get a certificate from the military, and you only have to submit it in the first year.
Okay.
And then every year after that, you bring in your property tax bill, and you have to have proof of payment in the calendar year.
Okay.
So that's critical because I had a client that doubled up in 1 year. So in the year that they didn't physically pay it,
Mhm.
they did not get the credit, or it's a credit, but what it is, they get their property taxes back. It's
Right.
basically that,
If they paid 4,000, they get 4,000.
yeah. So
Okay.
in that sense, it's not subject to whether they have any taxable income. So for example, a lot of my retired clients, if they're on Social Security is not taxable on the state.
Sure.
So they might not have any tax liability. The beauty of that credit is some credits only take out your tax liability and no more.
Yep.
This is, you pay it, you get it back. And
Okay.
it's a really nice, but of course you have to be qualified for it.
Yes.
But it's relatively easy to submit for. I would just really caution people to make sure that, like, for example, if your mortgage company is paying escrow,
Mhm.
make sure that happens in the calendar year.
Yeah,
They will deny it. You
Yeah.
pick it up the next year, but you'll
Yeah.
lose it for that year.
So here's why I'm bringing it up for you all as real estate agents. Not that you need to know the technicality, but I had this situation in a transaction where the seller was the spouse of a deceased disabled veteran, and they had the property tax credit.
They get it. They get it as
They
well.
were getting it.
Mhm.
And she was very concerned about her ability to get it, the portion she was going to pay at closing for the property taxes,
Mhm.
that she wouldn't have the proper documentation
Right.
to file with her taxes because she wasn't actually writing a check. No check was being written by her or her lender to the property tax authority. So the reason that I brought this question is, one, we want you to be aware that this does happen, and whether you're buying or selling a house, and if you got a veteran, you want to ask this to help make sure they're aware of it. But what is the paperwork in that transaction that they may need as a veteran?
Well, the certificate that they are qualified is already on file.
Okay,
So all they would have to submit is the closing documents to
Okay.
show that they left it in escrow.
got it.
Yeah.
Awesome.
So-
All right, here we go. Live question. Do you have to tell your tax person you got the credit, or will the tax person know about it when you hand in your tax docs? So I think this came while we were talking about the mortgage
mortgage,
credit
yeah.
certificate, but kind of use that in general of
Mhm.
how are you aware of these programs as a
They-
tax preparer?
Yeah, they have a certificate specifically. They have to bring it in. It has to be scanned in and submitted with the tax return.
Yep.
So again, I do not get a lot of those.
Yeah.
And it's a great program. So you have to let me know. I would have no really way of looking at your mortgage, 1098 paperwork and knowing that, you have it.
So even like the discount point we talked earlier, you need to receive the closing statement to know that it exists.
Yes and no, because
Okay.
it does show up on the 1098.
Okay,
Because there's a box for it, origination.
Got
forms.
it.
So
Okay.
I would say, you don't have to bring the closing papers in because there really isn't anything else we can deduct off of those.
okay,
Other than on when you could advise your clients to make sure you bring the closing papers in when you come to do your taxes.
Yeah.
That is another piece that a lot of people don't bring in, the buy or the sell.
Okay.
And sometimes they have a buy and a sell. And I need to prorate the property taxes based on what they left in escrow, and I need to prorate it based on what was given to them in escrow.
Yeah.
And that's all going to be on the closing papers. So it's helpful to have that. It give them that heads up, hey, when you do your taxes,
Yeah.
bring in the closing papers. They're often missing.
Yeah. Okay. So help your customers. And when January rolls around each year and you help one of your customers buy or sell a house, reach out to them. It's a nice touch point. I do this for mine and say, hey, if you don't have your closing statement anymore, give me a call. Let me know. I'll get it for you because you need it for your tax person to tell them all the stuff that just happened in the previous year. Awesome. Okay. So that was supposed to be more focused on the buyers. We're going to come to the sellers. Again, this is Ask ProVisor. We do it the second Wednesday of every month at 10 a.m. with various topics to help you as a real estate agent understand more things that you experience as you do buying and selling the houses. If you've got questions, please put them in the chat and we'll take them live as we talk. All right, let's now talk to I just got told that we're supposed to tell you our names. My name is Ritchie Baumann from ProVisor. This is Cori Huston from Convenient Tax Service.
My name is Cori Huston. Just.
Oh my gosh, there is no O in there.
Well, there isn't a D in there either. It's okay. It's okay.
It's live.
You got other good qualities. So just,
right,
yeah,
you.
you're okay.
You're just gonna be Cori from now on.
That's all right.
All right, we might have covered some of this. Now let's just do the tax implications for sellers. Capital gains.
Yes. Okay.
We were talking about this before it started. I had an impression of a rule. People are usually aware that if they're selling a house and they're profiting, which is what's happening a lot these days since 2010, 11.
Yep.
Talk about what the real estate agent needs to know if a customer is worried about that, besides telling them to come talk to someone like you.
Right. And again, we're trying to make sure that you don't give them information because it could put them in a trajectory. So it's a personal home sale. If you own a house 2 out of 5 years, and they say 2 out of 5, because you might have a house, you find another one and you're in the process of selling it. So they give you this odd to say it says 2 out of 5 years. As long as you've owned a house 2 out of 5 years, if you sell the house and you have a gain.
The last 5 years from when you're selling, going backward, those 5 years.
Yes, but it's specifically, again, to bridge if you have a house, like, so for example, if you have a personal home and you decide to move out but transform it into a rental.
Yes.
I mean, then you've got a different situation. So they want to look at they want to give you time to sell the house and not have the you can still have what's called the personal home exclusion, right? You just cannot have it within you cannot have two. You can't keep buying and selling and buying and selling.
Got it.
And enjoying the $250,000 equity exclusion.
Okay.
So oftentimes someone will come in and say, I've sold my house. What do I owe on that transaction? And of course, if you've owned it, let's say 2 out of 5, this is a weird way of saying it. If you've owned it, and a lot of people have owned their home for 40 years, right? And they're very worried about having this gain. So the IRS allows you to have $250,000 of equity gain per person. So if it's a married couple, it's $500,000 in this area. We don't hit that very often. So for the most part, you have either not even a taxable event, or if you have to record it, you just show a personal home sale exclusion.
Okay.
There used to be a rule that you had to buy up. So every year you had to buy up, and then you got what's called a once in a lifetime exclusion.
Okay.
I've been doing taxes long enough that I remember that, but that is not the case anymore.
Okay. So I'm going to throw a question out on our list, but on this topic, because I was just thinking we have real estate agents are helping people who family members have passed away. Now it's an estate sale.
Yes.
And the family's going to, let's just say, inherit the profit on the sale. What happens in that situation?
Actually, that's correct. So when you have, let's say mom dies and she's lived in the house for 20 years and now let's just say there's one beneficiary. The beneficiary owns the house. You get what's called a stepped up basis to the date of death. Okay. So if the house, let's say she paid 50,000 for it years ago, you're not looking at a bunch of gain because you get a stepped up basis to the date of death. And then you have the sale. So it's a very important mechanism because you could be looking at a lot of gain if we didn't have that. So if someone comes in and says, I inherited a house, there's a couple pieces of information that I would need. How many beneficiaries are we talking about? And then did the house, the record of the sale, the 1099-S, go into one of the beneficiaries, or does each one get one?
Okay.
And basically all you would do is you would say, okay, here's what you sold it for. Here's the value of the house when they passed away, and it could be that tax bill from that year.
Okay.
And then the beneficiary gets to take any of the closing costs against that. So you get
Okay.
real estate fees, title fees, fixing up fees. Those all add to that fair market value basis. So the bottom line on a sale of a home that you have inherited
Yeah.
is that you need to keep track of all of your expenses.
Yep.
You may be looking at a wash, and you may be looking at a slight gain or even a loss, and it's a capital loss, which you want to. So you want to take the time to process that. I have a lot of clients that I don't have them come, and I should amend that, because I do the process for them. But they inherited mom's house, they sold it, they don't have any information because they just inherited and sold it. So they could be leaving money on the table because, again, they stepped up the basis, and there are closing costs usually. Right. They have things. So I would always reach out to us. We can answer questions about that, but we're going to need those closing papers in that case.
That's good to know, because I'm actually in that. My mom passed away last year. My dad's still alive, but they bought their house in 1968 for $13,500. So at some point he passed away and I inherited. My cost basis is the value on that
day.
Now,
I'm going to put a little asterisk on that.
Yeah.
One of the things that you have to be careful of, and this is weighing into more of the attorney, and I have an attorney to refer as well for that, but you have to be really careful with gifting. I know that this is a question people get. So if you gift someone, say mom wants to circle the wagons on her assets a bit, so she gifts the house to the beneficiaries.
Yes.
She's just basically handed them a big bag of text, because gifting is exactly the opposite of this, what I told you.
Okay.
A gifting is when you get the gifter's basis. So the 13,000 would be your basis. So when you absolutely want to be careful weighing into these waters with people, but I would certainly know that gifting needs to be careful with gifting, and selling, of course, has the stepped up basis, and those broad strokes will help people like you need to get in front of someone that can answer those questions for you.
I never would have thought of that. So there you go. It's like, so again, we're sharing this here on Ask ProVisor just so you can have a basis of, like, when these questions come at you, you have a little knowledge, but get them to the expert. Okay. Costs. So they have a customer who's selling a house. Just, can you rattle off the things that you've seen in your time? Like, what can all go into that cost basis you just mentioned besides the price they originally paid? Seller.
Seller. So seller, if it's taxable, because if personal is selling a personal home, we don't get involved in.
Also, you got the exemption thing.
I mean, it would be the case if they're selling a rental. I mean,
okay, so let's do the rental. They bought the house. It's a rental. Now they're selling. It's a profit, and they got to determine the cost basis for that, right?
Well, they do. If they've been renting, I mean, you have to kind of cut me off. I can get kind of geeky myself. So you let me know. But if the issue with a rental that people do not realize, let's just put it this way. If you've owned a property for a while, you've had depreciation. So you're familiar with depreciation.
Yes.
You take the property and you divide it over 27 and a half years.
Okay.
So every year, someone who owns a rental gets 1/27th of that house. When they sell it, they have the profit.
Yep.
Buy, sell, but then they also have to add back what they already got benefits from.
Okay.
So oftentimes, if you have a rental, the unexpected profit is the profit you already took advantage of.
Okay.
Again, broad strokes are when you have a sale of a rental property, the time to talk to the preparer is before
you
sell it, because they might be looking at needing to make an estimate or put something in, because they're, for the most part, almost every real estate transaction that I've ever had a sale on has more tax than they come in thinking that they need, because they're thinking, I bought it for 100, I'm selling it for 150. That's a 50.
I think about like a stock gain. I mean, that's buy, sell.
Right. It's this sort of other benefit that they got all these years.
Gotcha.
But in terms of basis, it would be what they paid for it and the closing costs.
Okay.
And then capital improvements that they have had.
Done. Okay. So we just mentioned the word, like someone had a rental property. Let's just jump. It's in here. Can you explain what a 1031 exchange is and why it exists in a rental situation and taxes?
Well, it would only exist in a rental situation. So
Okay.
you cannot do a 1031 exchange on a personal residence.
Okay,
So what a 1031 exchange is, a 1031 refers to the IRS code that describes the behavior of this transaction. So it's basically, I have a rental property here. I would like to have a rental property in Florida, or I would like to have a rental property somewhere else. So you basically take the house, you sell it through an intermediary, an escrow agent. I'm
okay,
trying to think of you have to use someone who's qualified to take a 1031 exchange.
okay,
So the gain from the house of the sale goes to the escrow agent.
okay,
You have 45 days, and the timing is critical. You have 45 days to submit to the escrow agent the 3 properties you may want to buy.
okay,
So it's a little complicated, but if you follow me, so a 1031 exchange is a way to basically defer the capital gains on the property.
okay,
So you have to identify 3 properties.
mhm,
You have to buy one of the 3.
okay,
You do not have to buy all 3, but you have to buy one of the 3 within 180 days.
okay,
So the profile would be, I want to stay in the real estate game or the rental game. I'm
Yep.
not tired of clients. I want to keep doing it, but I want to have a different location, or I want a different property.
okay.
I had a client that had a rental. He
Mhm.
wanted to buy a rental in another location. So he sold the rental and bought the rental. And he thought I could roll that gain into the new property. He was incorrect because he didn't
He
use
missed
the
the
intermediate.
Got it.
That's the intermediary. So he didn't apply for that 1031. So basically a 1031 is perfect for someone who wants to stay renting, but wants to change. But again, it does not have to be a 2-up. It doesn't have to be the same configuration. You might have a 2-up, 2-down, and you want to buy a single family home so that you can rent it. It's just that the use has to be the same, and you cannot use it personally.
Who do you see, like, okay, so I'm trying to be the real estate agent. Okay, now I know there's this thing called the 1031 exchange. I'm dealing with somebody who's in that situation. How do they guide them? Like, if the customer, the investor's never done this before,
Yeah,
where do they find that escrow? Is that a title company?
you could look it up by 1031 exchange. There's companies that do it,
Do it?
specifically do those. Yeah.
Okay. And then maybe your title company does know of one or
Yeah.
something too, because they're handling a lot of money and they've probably had to see where they've had to wire the money to
Right.
that 1031. So
Yeah.
we just want to make you aware of it
Yes.
and that you can get more information so that you're ready when your customer is in that. Okay, we did that one. It's investment property. Does this 1031 apply to a commercial building?
Yes, I believe it's the same. That's a little beyond what I
Okay.
deal with on a regular, I would imagine,
All right,
because it's how they're using it.
how they're using it.
Yeah.
You're gonna want to
And
check
yeah,
that with
okay.
somebody,
Mhm.
because, our company ProVisor does residential loans. I don't get into the commercial space.
Right, I don't do, yeah.
But I did write it down to say, hey, you might want to check that if you're dealing a lot with investors to know the commercial side of it,
Mhm.
okay? Okay, this is Ask ProVisor. We do this every second Wednesday of the month at 10 a.m. My name is Ritchie Baumann. This is Cori Huston. Did I say it right?
Let's go with that.
Okay.
That's fine.
She'll tell you the right spelling when you give pronunciation when you give her a call for some wisdom.
Mhm.
She's with Convenient Tax Service out of Waukesha, Greenfield, and Florida. Give her a call if you got questions. We were talking beforehand. She has a very giving heart. She's done some other shows on TV. Who was the show out in New York?
Well, I did the Gus Ganorski show here in Milwaukee.
In
Yes, a couple
Milwaukee.
times. I own a Mary Maid's cleaning service, and we were profiled doing some tips.
Gotcha. I didn't know that show.
Yes.
Cori has come here just to help, and she's willing to take your calls. Let's see. Email, so just look up Convenient Tax Service. Her email is Cori@weloveyourtaxes.com. If you want to send
Because
her an
we
email.
do.
That's a great,
Well,
I love
thank you.
that.
I thought of that myself.
it's awesome.
I've been doing it 37 years, and I love it.
Wow.
I just love it. I don't know why.
All right. Well, if you've got questions that we're not answering or you want a more complicated question, she is very willing, said this right off the bat before we got on to give her a call, give her an email, send her an email. She's more than happy to help. And in that sense, I asked her let's talk about now a lot of real estate agents, you're self-employed. There are some that are W-2. So we're going to go into the third part of this and she's going to give you some wisdom as you get preparing your taxes now of what you want to see what you should be aware of as you do your taxes. For example, one of the real estate agents, you all sent me a question, so let's just do that one right away.
Sure.
This real estate agent is buying a new vehicle.
Mhm.
Okay, and her question is, because I'm thinking Schedule C. That's
Right.
what I see a lot as a loan officer. There's a line 9-ish is where you can have car and vehicle expenses.
Yeah.
And then on page 2, there's this section for business miles. And then I'm sure there's some depreciation in this possibly. So can you explain what can that person do when they bought a new vehicle? Can they do both? Can they only do one? Speak that a little bit to me.
It's a good question. I get that a lot.
Okay.
So the mileage rate the IRS allows self-employed individuals is 67 cents a mile currently.
Okay.
It's going up to 70 for 2025.
Okay.
So the theory is for all of you take the number of miles, either going from your home office, which I would recommend you establish a home office to lunches, to showings, your mileage for business
Sure.
is 67 cents a mile. That is a very high deduction.
Yeah.
And so what you would, it's first of all, it's relatively easy to record. So you have to make a choice between mileage and actual.
Okay.
The fact that you bought a new car does not come into play because mileage covers depreciation, gas, oil changes, car washes, repairs. It's everything. You take one or
line.
the other.
Okay.
The downside to actual is that you have to take out a personal percentage that you use the car. So unless you have a car that you completely only use for work,
Okay.
As well as the fact that it's harder to track. If you do actual in the first year, you kind of have to stick with it. I always recommend clients do mileage. Unless you have a luxury vehicle and you have very low mileage, I think you're going to be looking at the mileage is going to be better. Yeah,
Okay.
It's one of your biggest expenses.
Okay.
As a real estate agent, because you're always driving around.
Okay. What about, there's different ways they can structure their business. There's LLC, sole proprietor. I just don't want to Schedule C on their taxes.
Yeah.
There's subchapter S, and then there's the C corp.
Yes.
What do you see most often that they're structuring their taxes as a real estate agent?
I'll tell you what I see the most often, and I'll tell you what I recommend.
Okay.
Because if you go and you do what's called a LLC, which is limited liability company, what you're doing is basically putting a comma LLC after your name.
Okay.
In the sense that you're still going to have your profit, your closing costs, your 1099.
Yep.
You're going to take out your expenses. And then whatever your profit is, you're going to pay self-employment tax on, an income tax on.
Okay.
So that's what a Schedule C is. It's a flow through right to your tax return like that. So LLC specifically doesn't necessarily change how you're taxed.
Okay.
One of the pieces of advice I have for clients is there is a point at which in your business, you need to be thinking about changing your structure to an S corp, which in general terms means you become an employee of your own company. And so you can take your salary as a deduction to your business.
Okay.
And there is a woman that I work with. Her name is attorney Amy Farrow, and she specializes in, smaller businesses, people as sole proprietors or companies that have under 10 employees. And I asked her, where's that sweet spot where you go from LLC to the S corp? Because if you become an S corp, there are some other filing requirements and things like that. So she is recommending around, first of all, being in business for a year, just to make sure we can get a track record of what kind of income are you bringing in.
Okay.
And then also 50,000 in gross income, 50 to 100,000. I mean, that's it. If this is your full time and you can enjoy savings. Let me just see. She gave me the notes on what it was, because she sets those up. She said between 50,000, it could be 2,000 to 5,000 a year in savings and up as your income goes up.
Sure.
So 11 to 13,000 in tax savings every year on your taxes.
Gotcha.
So I would absolutely recommend her. I'm going to give her phone number. And it's Farrell Legal. It's Farrell Legal, 262-825-4707. So
how do you spell her last name?
Farrow.
Okay. There you go. Give her a call if you just like to discuss with her. Cori had told me ahead of time, we were trying to have Amy on. It didn't quite work out, but Amy as well is willing to take your calls, talk to you, and give you some wisdom as you do your taxes, whether you have somebody else do them or you do them on your own. It always is nice just to have a second opinion on some things.
Right. Right. I kind of liken it to having a little black book.
Yeah.
You all have your little black book for your plumbers, your go-to guys for fixing.
Yeah.
And now I'd love to be in that black book as well. But also you need this attorney in,
Yeah.
and even just to know what you don't know.
Yeah. So I asked you something, now, let's say they do their tax return or whatever, pick out the top, I don't know, 3-4 things that over your time of 37 years doing that you've seen real estate agents specific might have missed, might have done wrong, something that you could give them as wisdom to be attention to that they should make sure they're aware of, besides the subchapter, the S Corp structure.
Okay, that would be my first thing.
First one, okay,
and
top of the list.
So the other thing would be, I think most real estate agents are aware of the rough idea of what their expenses are. It's mostly going to be mileage and the cell phone and things like that, the office and home deduction. I think where it comes in is when they don't have a way to track those in a real time. Again, I'm just thinking the average real estate agent is again so responding to so many different needs, and
taking care of customers.
Right, and you can leave money on the table if you don't have a system to track it in real time, because then you're sitting there with your box of receipts and then you just want to get it over with, and you potentially are not capturing all of your expenses. So some way to make sure they track it better, I would say. And that's because every dollar that you can track is going to save you money. And I think real estate agents know that, but it's just hard to get into that habit. If
they just have a notebook sitting in the passenger seat and just keep writing it down, does that help you just to have a log of what you should be looking for?
Well, you need to have those summarized before you see me. This will be general for them just to keep track of it. But there's got to be phone apps. There's mileage apps. There's,
Okay. Yeah. All right. What other tips do you have for them as they look at preparing their taxes?
I would make sure that they look at getting into a SEP or a solo 401k, because of course, once you do make the money, you need to.
It's a SEP.
Oh, sorry, self-employed pension.
Okay.
So there are some very simple retirement tools.
Okay.
That real estate agents can use. They're not going to have that 401k if they're full time. They're not going to have that employer putting that money into that. Not so much pensions anymore, but like the 401k and the matching. Yep. So I think at the same time that you're out there making money, you need to be thinking about how can I use self-employment tools for retirement.
Okay.
Not only to reduce your taxable income.
Well, that's okay. So that's where my brain just went.
Yeah.
Okay. I'm not self-employed, but I know that I have a 401k. I always, if I owe money, I try to find a way that I can contribute more to my 401k, because why am I giving it to the government when I could put it in my own 401k? So is a self-employed person, if they have one of these, they prepare their taxes, they owe money, could they go back and yet this, like in 2025, write a check for 2024, put it in as an expense? And lower the tax liability.
It's not expensive.
But a contribution.
Right. And what's beautiful about a SEP, and you have to make sure you qualify. Again, the other person that you need is that financial piece. Yeah. But is that you have until October to make the completion of that. You indicate when you file what you're going to put into your, let's say it's a SEP.
By April 15th, you have to
can indicate, right. And then you have until October to make the
filing extension.
Right. The point would be, I guess my best advice is there's tools out there and you don't know what you don't know.
Yeah.
And again, specifically real estate agents are so busy and it's so easy to get distracted. So having some way, once your tax liability is figured out, you do have some tools to affect what your taxable income is after the calendar year. And you just need to work with someone that can help you maximize those. Okay.
Any others that you put on your list that you're thinking of?
I would say quarterlies. I mean, I know that real estate agents, quarterly taxes, quarterly estimates are right. People think of them as old people getting out their little checkbook and writing out the check. But I would say I often find self-employed people do not pay any taxes as they're making money, and then they get this big tax bill and they're surprised.
Yeah.
So it is very, very simple to set up estimates. All you're doing is you go to the federal.gov and you set up, either you could have it paid automatically, or you could somehow ad hoc pay in, and the state, and just sort of pay in some of the taxes you're going to owe, so that it's not such a burden when you go to file, because nobody's holding those taxes out for you. You have to hold them out for yourself. And I do find that a lot of self-employed people don't choose to go in and make estimates, and you can get a penalty if you have.
That's what I was about to ask. I'm like, isn't there a point? Like, if you're a new real estate agent and they started mid last year and maybe have done a lot of business, right? But is there a crossover to the point where the IRS goes, time out, you owed us money and we don't like the amount you owed us, you should have been paying us sooner?
Yes.
Okay.
And it's called an underpayment of tax penalty.
Okay.
It's calculated based on 4 quarters, and it's tied to interest rates. And I don't get involved in how they do it. Just be aware, it's a pay-as-you-go system.
Okay.
And you're supposed to pay as you go along.
Sure.
They don't really like it when you owe a lot.
Well, I'm W-2 employee. I get to pay as I go.
You're right. Everybody else has to. And the state actually is a little bit harsher than they can be a little bit higher. So I would just encourage people to go onto the IRS website. It's really easy to set up.
Okay.
And then you at least kind of are having these discipline habits to try to be anticipating what you're going to hold there.
Very good. I just want to jump in. Cori prepared this very nice packet. Okay.
Wait, I want to show you. Look here. See the heart? Are you seeing the heart? Love.
Oh yeah. Yeah. So she prepared this nice packet. If you would like this, just email Cori at weloveyourtaxes.com. She'll be happy to send it to you. And so that you can have a bunch of these notes that she's prepared for this time.
And Cori is C-O-R-I.
Yeah.
I would say that. Well,
CORI at weloveyourtaxes.com. I'm just really messed up. Wow.
It's okay.
Okay. How about, what if a real estate agent is a W-2 employee of a place? What changes for them? Because obviously not filing self-employment taxes. What should they track and what can they still take as a deduction? Because before we started, if you all remember back, it was in 2020, a lot of this changed of W-2 people and what they can
It
taxes.
It actually changed in 2018 with the Tax Cuts and Jobs Act. So, so you want the good news or the bad news?
Let's start with the bad first.
Okay, there is no good news.
Okay,
sorry. They basically, when they simplified the tax return, they took the standard deduction and they doubled it. So we could get into what that is, but that's basically a catch-all deduction that everybody gets. Right? And they took away these, what they call a miscellaneous employee expenses, which would be using of your cell phone, using uniforms and again, cell phone use, mileage, business mileage. I mean, you just said that's no longer deductible.
Yeah, the W-2 person can't do that.
They cannot.
Okay.
Unfortunately, unless they have to be they have to be self-employed. That's really the bottom line on that.
Yeah.
Some employers have restructured compensation so that mileage benefits can go into the W-2s or whatever, but there is no way to back out.
Okay.
I would say though, even when you could take those, it was still subject to 2% of your income.
All right.
So whereas it feels like a loss, it wasn't like if you had, 1,500 of these expenses, 1,500 came off your income. It was subject to what's called a floor. So that's maybe the good news, because you had that little bit that you really couldn't take it anyway. But unfortunately.
All right. One more impromptu question as we start to wrap up. Self-employed. I'm going back to self-employed.
Okay.
And I don't know the name of this program, but I just remember seeing some videos that companies needed to file something by the end of 2024 to explain the ownership or the people behind it. And I've wondered, who does that all apply to? So can you speak to that a little bit, and so that they know that applies
beneficial
to them?
Owner, I don't have the form number, but it's the beneficial owner filing. So originally you had until January 1st to file it, and it was 2 LLC members.
Okay.
It's for LLC members.
Okay.
Again, your LLC is Comet LLC, right? So they wanted to know more about the people that were involved in the company. Then they denied, then they put a stay on it, and now they've renewed it again. So and made it 1. The best thing, because the penalties.
What do you mean by made it 1?
I'm sorry, you before it used to be if you have 2 people in your LLC. Now it's 1. The best advice is to look it up, beneficial owner, because it's ping ponging back and forth. Whether you have to do it, it's not hard to do. But it is a requirement, and you'd have to go online to do that, to file it.
All right.
It's sort of like your annual LLC filing,
Okay.
But this is giving them more information. That's about all I can say about it because it's particular to each person and whether as far as I know, I don't know if it's back on or back off because they were putting a stay on.
Do you know why they started it?
Because they want to know more about you as a taxpayer.
Nice. So
The right thing.
So here's what we've said this several times when we talk about some of these topics, and this is a big one. Like if you just all of a sudden go, what did they just talk about? You've never heard this term before.
Mhm.
We're encouraging you. You need to get a hold of your tax person and ask them if this applies to you because the government wants to know who's behind the scenes of these LLCs. You may be doing nothing wrong, but you got to think creatively of people who take advantage of tax systems or want to do things illegally. LLCs get used to hide stuff, and the government doesn't want it hidden. So they created this to have every LLC file it. There are exceptions because I looked into a little bit.
Mhm.
There are exceptions, and you just got to know your individual. So if you haven't heard of it before, haven't paid attention to it, get a hold of your tax person. Wide open concluded question. Anything else you want to share? I'm going to have you share about your company a bit, but
Sure.
just on these topics, anything I missed that you came to mind you want to share?
You seem to have a good command of the issues. I would definitely reiterate that you don't want to get, just like a real estate agent doesn't want me to wade into those waters of any issues that could bring them into some liability.
Mhm.
You don't want to either. However, you don't know what you don't know, and your clients know even less. And there's so much misinformation. I mean, as soon as somebody says a guy at work told me this one thing, I know it's wrong.
Right.
And so it could cost them money and it could cost you money.
Yeah.
And so I would definitely, and if somebody's not willing to work with you or not willing to answer any questions for you,
Yeah.
find somebody else.
Find
because
someone
it's
else.
really,
Yes.
but I've been in business for 37 years. We are a family-owned company. And again, we have an office in Waukesha, Greenfield, and of course, if you want to get them done in Florida, you can come down there. But we have some answers, FAQs on our site. There's
Okay.
some blog posts, things about, there's some actual, another thing your clients could do is we've got real estate or rental property forms so they can track the expenses.
Okay.
So if you know you're selling to an investor, you could direct them to our site. They can download the monthly log for them to, because that's another issue.
Yeah.
Rental properties come in with this and
Yeah.
it's none of it's added up. And of course, they're leaving money on the table. If you're not tracking in real time, you're not always aware. It's most likely you're missing something. So you can be an asset to your investors or your people that buy rental properties by directing to our site where you can find those papers. There's actually even a small business Schedule C, like you were talking about,
Yep.
Schedule C right up there as well. So, and some other questions that we get frequently.
Very good. Her website is www.weloveyourtaxes.com. Reach out to her. Thank you for watching this Ask ProVisor. Next month, our plan is to have on a person, one of our operations people from ProVisor. We're going to talk about the condo questionnaire that happens in every transaction when you buy or sell a condo that's going to involve a loan. There are specific questions that have to get asked, and we have to know the makeup of that condo. And we want to provide that questionnaire. We're going to go through the answers. So when you take a listing, you can know what loan options you can actually accept in the offer based upon the makeup of the condo association and whether it's called something warrantable or non-warrantable. So please join us next month, March 2nd Wednesday of the month at 10 a.m. At any time, you can go to our YouTube channel at ProVisor and see all